Now, we'll tackle about Chapter 10, the installment sales method. So this chapter is crucial because it deals with a specific scenario common in retail and real estate where payments are received over extended periods. So it also presents a unique deviation from the primary revenue standard. So our objective for this chapter is to, or for you to state the applicability of the installment sales method. So this means understanding when we are allowed to use this method versus the standard method. And then apply the method, which involves calculating the realized gross profit, handling deferred profit, and accounting for special transactions like repossessions and trade-ins. So before we discuss the special method, let's quickly recall the core principle of PFRS 15. So the core principle states that an entity recognizes revenue to depict the transfer of promised goods or services to customers. The amount recognized should reflect the consideration the entity expects to be entitled to. So under PFRS 15, revenue is recognized when control transfers, which usually happens at the point of sale, regardless of when cash is collected. So, on installment sales method, however, uh, this will be a deviation from this um, principle. The installment sales method is a special case. So it is a cash-based approach to recognizing gross profit, and it deviates from the accrual principles of the PFRS 15. Okay? So when this is the when is this method acceptable for financial reporting purposes? Primarily, it is used in two limited scenarios. Number one is for taxation purposes. So the tax laws may allow or require this method, especially for long-term payment arrangements. And then second scenario is when the entity is a micro entity and has chosen to use the income tax basis of accounting. So in a standard financial reporting under PFRS for larger entities, the general rule of PFRS 15 is used. So under the installment sales method, we recognize gross profit only as we collect cash. This is crucial distinction from the PFRS 15 approach. So the gross profit from the sale is initially deferred, meaning it is recorded as a liability and not as an income. So as the installment payments are received, a portion of that deferred gross profit is recognized or realized as income. The realized amount is calculated using the uh, formula, following core formula, which is realized gross profit equals gross profit rate times collection on sale. And the unrealized portion of the gross profit, or the profit we haven't collected cash for yet, remains deferred and is presented as a deferred gross profit liability in the non-current liability section of the balance sheet. So to apply the main formula, we first need to compute the gross profit rate. Okay? We have three ways to look at this. We have formula number one, which is based on sale. So this is the most common. It is simply gross profit divided by sales. And then formula number two, based on cost. This is less common, but still used. And it is gross profit divided by the cost of goods sold. And this gives you the markup percentage. And then for formula number 3, this is a variation of formula number 1, and is used when we are looking at future realization. It is deferred gross profit divided by installment account receivable. And we also need formulas to determine the balance of the deferred gross profit at the end of the period. And for formula 1, number 1, this is the change in balance. So what you need to do is you take the total unrealized gross profit from the start of the period and subtract the realized gross profit during the period. This will give you the ending deferred balance. And then for formula number 2, this is the direct calculation. The deferred gross profit at the end of the period is equal to the installment account receivable ending, and then multiplied by the gross profit rate. So now let's talk about repossession. So there are instances wherein sometimes the buyer defaults on their payment. And when this happens, the seller or the installment vendor may repossess the property. So we must record the repossession and determine if there is a gain or loss. And the pro forma journal entry is shown. Okay? A debit to inventory at fair value, a debit to deferred gross profit for the remaining unrealized profit on that sale, and then a debit or credit to loss on repossession. This usually is the balancing figure, and a credit to installment account receivable to clear the remaining balance. So the fair value of the repossessed property is critical. It is defined as either the appraised value or the estimated selling price less reconditioning cost and normal profit margin. So that is for repossession. How about for trade-ins? So another common feature in installment sales is the trade-in, where the buyer exchanges old merchandise as part of the down payment for the new merchandise. So the merchandise we receive is debited to an inventory account at its fair value. Okay? And when we say fair value for the trade-in merchandise, this is similar to the definition to repossession, which is either the appraised value or the estimated selling price less reconditioning cost and a normal profit margin. So the complication comes when the trade-in value, or what we promised the buyer, differs from the fair value or what it is actually worth to us. So if ever there is an over allowance, and this happens when the trade-in value is greater than the fair value, the difference is an over allowance, and this is essentially a hidden sales discount, and we treat it as a reduction to the installment price of the new merchandise when calculating gross profit and gross profit rate. While if ever there is under allowance, which happens when the trade-in value is less than the fair value, this is rare, but if in case this happens, this is treated as an addition to the installment price when calculating gross profit. The key concept is that the actual gross profit on the new sale must be computed based on the economic substance of the transaction. And then we have the cost recovery method of traditional accounting. So finally, for completeness, we have the cost recovery method, which is generally not PFRS compliant, but is sometimes covered in traditional accounting. So under this method, no gross profit or interest income is recognized until the total collections from the sale exceed the cost of the inventory sold. In essence, every peso collected initially is treated as a return of the capital until the full cost is recovered, and then that's the only time when profit is recognized. And this is used when the collectibility of the receivable is highly uncertain. So that concludes the overview of Chapter 10. As a note, again, installment sales method is a distinct cash-based approach to profit recognition, primarily used for tax or micro-entity purposes. And this method requires careful application of the gross profit rate, especially when dealing with repossessions and trade-ins.